They will be starting shortly. Good afternoon. We're still waiting for people to come online, so we'll give it a couple more minutes. Thank you. Good afternoon. We're still waiting for people to come online. We're expecting about 180 participants. We're on 95 now. We'll probably make a start just as we hit the 100 mark. Thank you. Okay, I think we'll make a start. Well, hello everyone, and thank you for joining the second in this series of In Conversation With. As some of you know, it's a succession of one-on-one discussions where we interview recognised and celebrated individuals who are of direct interest to CLA members. So on behalf of the CLA, I'm delighted to welcome you to what I'm sure will be an informative event. My name is Mike Valencia. I'm the Regional Director for the South East. Now, today's discussion is one that brings together the CLA President, Mark Bridgman, and Mark Suthern, who's the National Head of Agriculture for Barclays. Future sessions will include Henry Dimbleby, so do look out for those. I do need to remind you that today's session is being recorded for future use, including availability to our members. And the format for today is your microphones and videos will be muted throughout the webinar. The format is that Mark Bridgman will have a discussion with Mark Suthern, after which he'll pose questions that you ask. So do please feel free to ask questions at any time using the Q&A button on your screen, and he'll attempt to cover as many as possible at the end. Thank you very much. I hope you enjoy the session. I'll now hand you over to the two Marks.
Thank you very much, Michael. Welcome, everybody. Good afternoon. And first of all, Mark, thank you very much for joining me. Good to see you. You see, I put a tie on for my bank manager. I hope you're impressed.
Yeah, and I'm in a check shirt and a gilet to represent
my first Zoom tie. Okay, so I thought we're going to chat for about 25 minutes, and then we'll take questions as they flow in. I thought just to sort of set the scene, I'd ask how you're finding, how your clients are coping really with COVID-19 and the crisis, how they're reacting and adjusting. And perhaps you might sort of illustrate it with the sort of the good, the bad, and the indifferent, because clearly some people are really suffering, and some are bumbling along okay.
Yeah. So firstly, Mark, thanks for giving me this opportunity, and thank you for your members for dialing in. So a couple of things. When Michael said at the beginning, he talked about recognised or celebrated. I don't think I've ever been celebrated, and with this COVID beard, I'm not even sure I'd be recognised. So for those of you that don't recognise me, this is my protest COVID beard, which hopefully will have gone next time you see me in the flesh. And also at a time when it's this COVID-19, I do hope all of the people that have dialed in today are safe, that their families are safe, and their friends and colleagues are safe, because it is an unusual time and something like this. So how are our clients responding to COVID-19? You're absolutely right, Mark, in a number of different ways. I think agriculture as a sector actually has a significant strength, because many of us live in social isolation, so we are used to this. But when we start then drilling down into the sector, there are some challenges. So I've spent quite a bit of my time recently talking to our clients and talking to people in the sector. Interestingly enough, one of the themes that came out, and as chair of Farming Community Network, it's really interesting because it's actually about how are people coping with their own mental wellness. So one thing that we should never forget is the importance of this type of connectivity, so that we can all make sure that just on our own health, we are robust and continue to network with each other. So interesting that should be some feedback. If I then start looking at the sector, it is a really a mixed bag. There are some real successes. If I start thinking about, if I think about the combinable crop sector, actually for many people, COVID-19 hasn't yet impacted, and we're not really seeing an impact. I talked to some clients in the produce sector. Really interesting that they should say that their turnover levels are at pre-Christmas levels. They're up 30%, and the supermarkets are operating on a revised spec. So we're starting to see some sort of interesting trends there in produce. If we look at eggs, because of people being at home and working from home, we're starting to see the demand for eggs continue to be very, very, very high. If we then start looking at the dairy sector, obviously there are some serious disruptions in specialised chains, and that's about 10% of the sector. Now, that's really been highlighted on the press and on the TV. Conversely, there are others with different contracts that are actually managing okay. So it isn't right to say that there is a sector. If we look at livestock, so the impact of maybe demand for steaks. On the flip side, I read recently that the demand from France for lamb is now starting to increase again. So we've got the sort of an uplift there. There is a sector that obviously has been impacted, and that is ornamentals. If we look at from a horticultural point of view, the ornamental sector. And so in amongst all of this, where it's a sector that's been clearly impacted, we've got examples where we've supported family-run businesses with civil loans, and they've actually pivoted their business. So they've gone from being a business to consumer, where they've actually gone online, and a business to business. So it's really interesting to see how certain businesses are already adapting and changing their business model. And the intention is for some that they won't go back. There's other success stories where we are seeing in sort of top fruit, soft fruit, where people from different sectors who are furloughed are coming into work. But now the diversification, which is something that we've talked about as banks for many times, clearly that the sort of holiday cottages, wedding venues now are being mothballed. So there is a real mixed bag.
Okay, Mark, thank you. And obviously, for those that are struggling, the government's put a number of schemes in place, loan schemes. The banks have been getting a bit of a pasting in the media, particularly around the CBIL scheme. Yeah. I just wanted to get, maybe you could sort of give your view of that as to how Barclays in aggregate you feel is coping, and particularly your agricultural sector, how you're using the scheme, if you are, how much you're using it. And obviously we've got the new small scheme, small 50,000 loan scheme. You might have a view on that, but particularly that bigger one, the CBIL scheme, that's set up to really try and help people who are struggling? Thanks.
Yeah, I think we've all seen, and we must all welcome the government and the Bank of England's sort of business support programs, whether it is the loans, the grants, or even the sort of the furlough schemes. Now, you asked me specifically about the Sybil loan, and yeah, that was a really interesting support program for the banks to change systems, to change their approaches, but as Barclays, we're really proud that since the 24th of April, we've done a significant amount of commercial paper. That's for the really large COVID corporate financing facilities. But we've also lent 737 million under the COVID business interruption loan. Is it COVID business loan, CBILS? We've also, but as importantly, we have put in place nearly 240,000 capital repayment holidays on both personal and business mortgages. We've provided over 6 million clients, both personally and from a business point of view, a sort of moratorium on fees and also on interest on their overdrafts. And that's for businesses turning over up to £250,000. So we believe we've done the right things. We have got the loan working. There are examples where we have supported the agricultural sector, and I'll come back to that in a moment. We've also launched a £100 million COVID Barclays Foundation, which is to support the charities and the community with handouts really that have been really impacted by COVID-19. But you asked me specifically about Sybil loans for agriculture. When the loan scheme was started, agriculture as a sector it used the same rails as the Enterprise Finance Loan Guarantee Scheme, which was a loan scheme to help businesses that were lacking in security. The Sybil loan, the Sybil loan used the same sort of rails and infrastructure as that. Agriculture in the past, because of BPS payments, had always been excluded because of state aid and the double counting of state aid. Agriculture is now within the scheme, so up to certain caps. And so initially there was a little bit of confusion. There was also some confusion about whether we would use security and guarantees. These have all been managed through now. And we are seeing agricultural clients, landing-only clients, applying to Barclays and applying to the other banks to use the Sybil loans. The ornamental example I gave you, where we've seen it used successfully, we've seen it used successfully with a tenant dairy farmer, a herd of about 300 cattle. So we are seeing it used. Is the take-up as great as the SME sector, the sort of retail and wholesale, hotel and leisure? Well, clearly not, because the impact, if you're on a sort of scale of 1 to 10, the impact on many farmers is less than if you are running hotels, running cafes, running family shops. So we've seen big take-up there.
Yeah. Okay. Thank you. You mentioned capital repayment holidays. Obviously, the banks are being asked to show flexibility, and you touched on some of that. As we start to think about restarting the economy, and certainly the CLA, we're working on that with government and feeding in our thoughts about how we restart gradually, as led by the government as far as what we can do. But the banks will form a key part of that jump-starting, providing liquidity. What are your thoughts around flexibility that the banks are showing, and also for new loans? How do you think the current crisis affects your attitude to new loans, if at all?
Yeah, I think so. One of the conversations we often have with either government or with trade bodies or with our clients is that we sometimes need to step back and realise that across all the banks, only 1 in 2 farmers will borrow from a bank. So 50% of all farmers do not borrow from banks or lenders. So that impact about where we're going to be is really interesting for the future. When I talked about capital repayment holidays, by mid-March, we'd already issued 1,000 capital repayment holidays across the agricultural sector to give people that breathing space. I think as a as a banker in the sector, one of the things that I always reflect on is how resilient and how innovative many farmers and landowners are. There is a sort of an aspect of this community which we often forget, which is that intergenerational transfer. So, many people are third, fourth, fifth, sixth generation farmers or landowners, and that gives a strength and a purpose. So, direct answer to a direct question: we are not looking to do anything but continue to support the sector. From Barclays' point of view, agriculture is a vital sector. It's one of the reasons why we have it as a distinct business. The agricultural managers that are out there phoning their clients on a daily basis at the moment are only focused on the sector, which allows us to be so passionate about it, but committed to the future. I think that's the key message I want to get people across, is that we see it as an opportunity for the future. Do I see any changes? We've just launched this year a 25-year interest-only loan for certain clients. That is a real commitment to long-term investment in the sector.
Okay, Mark, thank you. Just to remind everyone who's listening in and participating that if you want to ask a question, we've had some in already, some sent them in previously, but do put them on the type them in, and I'll pick them up when we finish. So, Mark, that was a fascinating statistic you gave just before, that 50% of your farming clients don't ever borrow, I presume, other than overdraft facilities. I'm certainly in the other 50% camp. So right now, I was looking at, I've never seen interest rates as low. I think they are not multi-year, but multi-century lows. So short-term bank rates are 0.1%. 10-year gilts are 0.3%. So they've never been lower. What's your view about the outlook for that? For those loans, and your and the advice that you're giving as a team when people come and talk to you about short term versus long term, and your view on those very low rates?
Yeah, so those very low rates do fascinate me, and it shows about the role that the Bank of England is having to play in our economy. And since 2008, when I was a credit underwriter, what feels like 100 years ago in Shrewsbury, of all places, in Shrewsbury in Shropshire, I used to always do my sensitivity analysis on a base rate of 10% plus margin. And if the client that was submitting the case could support it at that rate, then it was something I wanted to support. And that was my sort of due diligence, 10%. I also had a mortgage in the sort of late 90s, and I used to love the letter that came once a month from the bank telling me my mortgage rate had gone from 11 to 12 to 13 to 14 to 15%. So I tell those stories really, Mark, because 0.1 is such a historic, is exceptional and extraordinary. It is a really interesting time to take a step back from what the day-to-day of your business and to think, what is it that we want to do? If we to grow our businesses sustainably, what are the assets that we want to sweat, and why do we want to sweat those assets, and why do we want to invest? You mentioned the gilts at 30 basis points, 0.3, something like that. This morning, knowing that we were going to be talking about investing and things like those are the sort of questions I expected to come. I was intrigued to see what the bank's own fixed rate would be for 10 years. So it feels as though if I came to you as the client, because you look much more like a banker than I do today, if I came to you and said, look, I'm thinking of investing in my farm, I'm looking at 10-year monies, our 10-year fixed rate is 0.48%, 48 basis points, to which obviously there's a margin and all the other bits and bobs. But fundamentally, so good value, compare it to my experiences as an individual borrower. So that is a real commitment. So again, if I was looking at it and I was looking to borrow myself, if I was borrowing £1 million, I probably would be wanting to take some at fixed to give me that certainty, and some at variable, so I could pay it off, you know, from profit. So I think there's a real opportunity for people to take a step back and think about what it is they want to invest in, why they want to invest it, and this is why you know, interest rates are where they are. It is that opportunity to invest.
Yeah, thank you. I remember I took my first mortgage out in 1991, I think it was, and going through when we crashed out of the exchange rate mechanism the next year. I remember interest rates at 13% or whatever they were. It was a very different world. People people forget it.
Yeah.
Now the government, yes, interest rates are incredibly low, and basically they can't go any lower, but they could go the other way. I mean, you could paint a scenario where the bank is just generating money, the Bank of England, massive expansion of the country's balance sheet.
Yeah.
It's classic, you know, it's almost what they call in America helicopter money, where they're just starting the printing presses. And we know what happens when you start the printing presses. Do you think the risks are greater for a deflationary period because we're going to have an economic crunch? Or do you think the risks are greater that this could generate in 2 or 3 years' time some serious inflation? And it links back to your point about long rates versus short rates.
Yeah, so interesting. I think that previous assumption that the printing money by government always created that sort of level of inflation. You know, we saw it in, you know, historically we've seen it in Zimbabwe and 1 or 2 other places. I think that's sort of being ditched now, that sort of belief that there's going to be that runaway inflation, to a more sort of nuanced monetary policy, which is that if the economy can absorb the cash, if there is capacity to grow, meet additional demand, then that will allow those increased money flows to be absorbed. So I don't see inflationary pressures because of the government policy of that helicopter money. Do I see deflationary pressure? No. Similarly, I don't think the economy will be such. And Mark, just apologies if the dog's barking gets picked up here. So
don't worry, we're all used to these Zoom calls and what happens. I'm going to just finish off with one more sort of broad question, because I want to be able to take some questions from our participants, and that's really, as we adjust this sort of extraordinary period of lockdown, we start coming out of it. What do you think? And you see a lot of businesses, and you run a big business yourself. What do you think some of the lessons learned will be? Whether it's our attitude to flexible working, this type of technology, commuting. Or on the other hand, where do you see the opportunities for those of us running rural businesses, diversified businesses, whether it's food provenance or food supply? Fairly broad question. You might
no. I'll try and give a sort of a broad, sort of fairly personal answer. But it's Barclays as a group announced its quarter one results, and our chief executive, Jez Staley, and it was, I read it on BBC, so it's not. I'm not saying anything sort of that's confidential, but it's really trying to talk about, why do big corporates all need to be based in big city blocks when we're able to operate like this? We've got yourself and I, Mark, having this very sensible conversation. There's a couple of hundred people listening in. So you start thinking, well, what does real estate look like in cities? Consequently, then what happens to real estate in cities and the associated service industries? The sort of the cafes, the restaurants, the pubs and bars. Somewhere like Canary Wharf. What are the impacts? So I think there's some changes there. I think one of the interesting statistics I saw only the other day is that 2 in 5 adults now have said because of COVID they're spending more time prepping food at home. So I think one of the interesting things for UK producers is to see how we capitalise on that increased demand for UK provenance food, fresh food. It's fascinating to see here in Lincolnshire. Suddenly from nowhere we have a milkman delivering milk. I haven't had one here for 19 years. the butcher has changed his round. The baker is delivering bread in our village, which didn't happen before. What else have I seen? Farmers delivering vegetable boxes, white vans that I just simply haven't seen before. So I think that there's also then, if I look at your members in particular, and particularly thinking about some of the larger commercial opportunities, why will all of the why will everybody want to start commuting back to the cities from the rural area? And I think there is a real opportunity from a commercial tenanted point of view that you will see more people thinking, well, I can do this myself. Why do I need to work for a corporate in London when I can be a PR manager based in Shropshire or base myself in Northumberland? Why do I need to do that travel every day? It's really interesting. We've already started to see an uptick in the formation of limited companies. I think one of the opportunities, though, for your members is to think about that whole thing about superfast rural broadband. I think that there's a real opportunity. So lots of different things going on, and conscious there's probably quite a few questions coming through as well.
There are. Well, Mark, thank you. Yeah, the superfast broadband, the fibre optic cable has got to the outside of my house, and then COVID hit, and I'm so close. But we've got it at the farm where I run my tourist business, and it's just transformational. But you're right, it's key for that to work, and obviously CLA are fighting hard for that.
Yeah.
So I've got lots of questions, and please do keep firing them in. A nice frivolous one to start with from Joanna Barclay. If you work for Barclays, why does he have a HSB poster on his wall?
Right.
You tried to hide.
I tried to hide it. So good eyes, whoever that is.
Yeah.
It isn't an HSBC poster, but I can tell you, for those of you that are interested, you are in my study, and behind me is an England versus Sri Lanka signed shirt. I have the 2004 Middlesbrough Carling Cup and the South Africa British Lions shirt. I bought shirts that are signed or they've been given to me as present. Good answer.
Very good. Okay. So good spot. So slightly more seriously, Christopher Finley has written, do you anticipate a double dip caused by COVID and Brexit to land values, investment in machinery, and farm gate prices? That's a cheery thought.
So a very simple, straightforward.
Sort of three aspects to the question.
Yeah. So do I envisage as a bank of that sort of double dip sort of recession? No, I think it will be really interesting to see how COVID-19 sort of pans out. We as a bank, whilst we've got thousands of people absolutely thrown at sorting out CBIL loans and supporting the SME sector and the agricultural sector, we also have a team of people saying, what will the new normal be like, and how do we support the UK economy going forward? So we're committed to that directionally. What none of us know is will there be another peak? And I think that it's that unknown that creates uncertainty rather than the fact that do I think the economy. So do I think it'll be a double dip? No. The piece about land values, again, I don't sense or read that there will be. When we had all of those discussions about Brexit, and various people painted this sort of scenario that land prices would crash through the floor, and there would be real chaos in the countryside. That hasn't come to fruition. The assets in the agricultural sector are circa 250 billion, maybe a little bit more. Net all bank lending is about 11 billion pounds. So there is a lot of capacity in there. Do I think demand will still be there for machinery and for basically we have just done some work with a new provider of asset finance, and we have just seen today the first agricultural. The training was only done this week, so we are seeing demand as it's happening at the moment. So no, do I see those as risks? No to land price, not at all, Mark.
So, I mean, you just a quick one on land prices. I hear what you're saying, but the counter argument is we haven't actually really exited yet. What happens if we didn't get a good trade deal with Europe, and those nice people, our friends from America, start sending us cheap food. You know, paint a tough scenario. If you're a banker looking at a long-term loan, to me, how have you changed how you assess land values?
Yeah, I suppose. Yeah, so how do we assess land values? I think the really important thing is to remind ourselves where do we start when we do lend money, and you know, we do not lend straight to the deeds. You know, that's the really important thing to think about. We are a bank that is focused on having agricultural managers have a relationship with our clients. Some of you may have seen I sometimes use the Campari. You know, we talk about the character of the person we're lending to, their ability, their means, the purpose. You know, so we are still going to be focused on who is sitting in front of me. Do they have the ability? Do they have the means to deliver and to make a return on that investment? So, you know, the land it is, to all intents and purposes, the security that is there for those. Gives us the confidence we are a, if you like, a retail bank, not an investment bank.
Okay, Mark, thank you. Next question comes from Paul Wolferston. How has Barclays' approach to assessing long-term risk in the agricultural sector changed in the light of Brexit and now COVID-19? The views about long-term risks.
Yeah, long-term risks.
It's a bit of a follow-on from the last question. But,
yeah, no, I'll probably, yeah, long-term risks. I'm just jotting it down so I don't forget it. And it's good question, Paul. And long-term risks. Before Brexit, we did, as one would imagine, a lot of analysis of our book, and we changed none of the sort of approaches to lending or our appetite to lending in the sector. People say, well, what about BPS? We took the view that the sector is very resilient, and we took the view that farmers would be able to either diversify or get off-farm income. So the view there, Brexit, we looked at it and we didn't change our appetite. We were mindful of a number of risks, the trade agreements and labour, but we didn't change our risk appetite. COVID-19, agriculture in COVID-19 remains such a important part. If we think about the risks that have been impacted upon, retail and wholesale, we saw today on the news, I think British Airways has made a significant number of people redundant, which is not pleasant at all. Ryanair today. So other sectors are feeling that pressure, in my mind as an agricultural banker, in a more greater, intense way. To the future, and Paul's question is really interesting because I began 2020 spending quite a lot of time with different regulators and different people within the organisation, looking at a different risk, and that was the risk of climate change. Again, it's in the public domain. The banks regulators, all banks regulators, the PRA and the FCA, are very interested in what our response to climate change will be, and whether that's for people's homes, flooding and things. I can counter that, Mark, in many ways. I think I see climate change. Yes, it's significant, and it's something that I am concerned about privately. But I think we live in a very temperate climate. I'm sure sometimes when you're on your farm in midwinter, you think, maybe those. I'll say it now, and you can remind me when you're putting your bobble hat down. But we live in a fairly temperate, benign climate. We don't have the extremes that we had the floods, but we don't have the extremes that other parts of the world have. Climate change is actually starting to create some opportunities. We have clients that have, changed their production models, what they're growing, because of the opportunity that's created. The vineyards in Kent is a really good example. We're starting to see some clients growing apricots. We're starting to see different patterns emerge. So whilst climate risk is a really interesting new risk, I actually see it as an opportunity as well as a threat.
Okay. Well, I'll do a quick CLA plug on, let you have a sip of your coffee. We are our big annual conference, which I hope a number of you are listening come to or will come to this year. It takes place at the end of November every year. And the theme this year is the road to net zero. So it's all about how we as farmers and land managers need to think about the risks, but also the opportunities. It was due to coincide with COP26, which obviously been postponed. Hopefully our conference won't, and we've got some fantastic speakers coming to inform us about that whole climate issue and carbon. Right, my next question is it's just coming in, flowing in, so please keep them coming. From John Creswell. If you are currently pricing 10-year fixed money at 0.48%, what are you charging for 25-year interest only?
25-year interest only, we would be looking at a normal rate. That's a variable rate. So it would be the client's agreed margin plus 0.1%, because it's a variable loan, Mark. So the margin.
So to clarify, you're lending money for 25 years, but it's not a 25-year fixed. We do a 10-year fix, which I think is probably for most business prudent. But for that John's specific question, it would be the agreed margin over variable funds, so for 25 years base. Okay, thank you.
Yeah.
A broader question from Martin Collison. Do you expect the crisis to stimulate more industry restructuring?
Hello, Martin. Industry restructuring. If by that Martin means farms merging and perhaps what I think this crisis may be an accelerant for is cooperation. I am fascinated and impressed, sort of on equal measure, by the amount of cooperation and support that I'm seeing. And I think that we're starting to see that again within Brexit. Brexit was starting to do that. I think you will see more examples of farmers collaborating, sharing knowledge exchange. So I think there will be a sort of a structural change to that about openness and support. There inevitably will be, because the pattern is there will be a certain amount of consolidation. Do I think it'll be rapid? No, I think it will probably follow the same curve, the same line of consolidation. But I do think we will see more collaboration.
Thank you. I'm going to go to probably run a few more, because we've been going for 40 minutes and the questions, very good questions come in. This is a rather more specific one from Mike Tristan regarding CBILS. Some lenders are asking 1.5 to 2 times EBITDA on serviceability of those loans. With 80% government guarantee, surely 1.25 times EBITDA cover is enough for lenders.
Yeah, so I suppose the first thing to remember, really good question, a really sort of technical question there for John, is that the 80% guarantee is the security, and as a bank we take no pleasure from ever exercising security. So it is about the serviceability, because with a CBILS loan, which is over a sort of 6-year term, yes, the first 12 months are sort of interest-free, capital-free, fee-free, but after those first 12 months, the borrower will have to start paying back that debt. And traditionally we have operated on a sort of EBITDA ratio of 1.5 times. That's after drawings. So I think I understand the question. Is there some flexibility? I think for me it is a prudent cover at 1.5 times. But I suppose what I'd say, particularly to that question, Mark, is that if the questioner isn't happy with my answer, I think Pip's got my email address. So if people wanted to drop a note to Pip, then I'd be very happy to have a sort of private offline conversation.
Thank you, Mark. And just to reiterate, Pip Watkins, who who will be the person who invited you on in your diary as the person who initiated the Zoom call, who's part of the Southeast team. So I've got another one now from Mike Holland. How will Barclays approach cash flow management and forecasting with clients over the next 12 months, particularly when income from diversified enterprises that's dependent on summer-spring trade has been hit by the current COVID restrictions? I guess you touched on that a bit earlier, but maybe just...
Yeah, no. I think it's a really good question, and I think when we look at a cash flow lending, we look at forecasts. I think it really depends on the individual client, but it also depends on the length of the project. If for example, if Mike had been running a wedding venue for the last 15 years, and we've seen sort of year-on-year increase in turnover and profits, and then we see this drop down, and then we start the forecasts say, well, there will be a pickup, and this is where we expect to get back to 2019 levels by 2022. As a banker, I'd start to believe that. Now, if the business had been trading at losses with erratic turnover, and then said, oh, after COVID, my turnover is increase exponentially, I'd probably be a little bit more skeptical. So I think how will we view it? I think we'll review it based on previous track record and use that sort of application of thought and discussion. As I say, a business that's been making losses and having a sort of up and down cash flow suddenly to predict, great, we'd start to be questioning a bit more detail. Not to say that we wouldn't support, we just want some more information.
Yeah. I think I'm going to make this the last question. This is a fairly broad one, and I've got some personal views on it as well, and then maybe any closing remarks you have. But question from Bob Hill. Moving forward, what impact do you think COVID-19 will have on farmers and landowners' view of diversification into tourism and leisure activities? Because obviously a lot of those consumer-facing businesses are being absolutely, having a desperate time at the moment.
Yeah, really, a really interesting question. I sort of almost touched on it, and maybe I didn't sort of touch on it enough at the beginning. Because I have reflected on this as a banker, that for the last so many years has stood on a stage with my colleagues, and we've talked about diversification, not making sure you've got your eggs in on one basket, how do you get other income streams, and now we're in this opportunity where people are thinking, gosh, what have we done? So if we think particularly about hotel and leisure, cottages and things like that, I was talking to one of our clients a couple of weeks ago, who runs a successful sort of cottages type business in the south part of the country, and he really sort of refreshed me, because he's really optimistic, because his view is that many of the UK population will want to stay at home. So I actually think that once lockdown is released, I think it will be harder for us, and to answer that question, Bob's that question, I think it'll be harder for us to want to go on holiday abroad. I saw something about Spain saying that Britain will be at the bottom of the queue of people that are allowed back into Spain, and for various reasons. So I actually think that we will start to see the UK staycation, people holidaying at home. I think we will see a spike in activity, and I think we'll see more people. And again, bringing it back to my own personal level, we always think we're individual. My wife and I had this conversation because we had to cancel a holiday, and I had to cancel my trip to Marseille to watch the rugby, much to my disappointment. And we both said, well, I think this year is the year we ought to look to holiday in the UK, because we just don't want to be caught overseas. We're lucky enough to go overseas, and we don't want to be caught. When you start thinking, well, that's just us, I think so many people are doing that. Sorry, you've got your views on this as well.
Well, to be honest, they're remarkably similar. I really think when we get over this, there's huge opportunities. I think, yes, it's tough, particularly tough for those that have really sort of rolled the dice and gone into diversification in a big way, and maybe just gone to their friendly bank and borrowed a lot of money, and it was really, really tough. But I personally think tourism, I think, is a huge opportunity for all the reasons you said. And then also diversification, where we started this conversation about, remote working, why, I look out over a, lovely scene from my office in rural Northumberland, and I can do my job from here. You don't necessarily have to commute into central London. So I think, there will be opportunities, as a result of that. So thank you, Mark, very much indeed. It's been very interesting. We've had lots of questions, and I apologize for those whose questions we haven't answered. Some of them around interest rates and inflation, deflation. We've had a few on that, and obviously, hopefully, we picked that up actually in the Q&A. Mark, thank you. And just to remind everyone that the next one of these in conversation with, which I'm going to be doing, is with Henry Dimbleby, who is chairman of the National Food Strategy. National Food Strategy is the government's first really major review of food since the Second World War. So that should be very interesting in a couple of weeks. And with that, thank you, Mark. Thank you, everyone, for joining. Have a good weekend. And I'm going to hand back to Mike. Thank you.
Thank you.
Well, thank you very much to both Marks. I really do hope that you found this session informative and enlightening. I certainly did. It was fascinating. And good on Mark for putting himself in the firing line, so to speak. I do hope we meet again soon, perhaps as early as next Wednesday's event on the future of farming. Where will we be in 2050? That's next Wednesday, starting at 11 a.m. Mark mentioned the Henry Dimbleby interview as well, which is in a couple of weeks. Look forward to that as well. Just a reminder again, this session's been recorded and will be available on our website after this. Otherwise, goodbye and have a very, very good weekend. Take care. Bye-bye.